As we continue to get good news in the housing market, we just don't understand what the FHFA and the government are actually doing. Those articles, and guess what's back? 100% financing, but not here in the United States. I'm hoping that all the lenders out here understood what the issues were in 2008, 2009, but other places of the world haven't gone through that pain yet. That article and more on Real Estate Daily. Welcome, everyone. My name is Troy, and every day we go over the latest news in real estate, housing, and the mortgage market. Now, before we jump into it, do me a favor, hit that subscribe button. Boom, 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 boom. Now, if you out there looking to buy a home, and as we see mortgage rates dip and more of you are seeping into, becoming a buyer of real property, do me a favor. Today and forever, I should say, or not forever, but for the foreseeable future, I'm giving you a buyer's guide. Go down below, click that buyer's guide link, enter your email address, and I'm going to send you out a buyer's guide for free, no charge. All right, so let's jump right into it. This is from USA Today. This says housing market on the rise, mortgage rate dip as immediate impact on several aspects. So we're seeing these articles come in, and they're going over and over as everybody's anticipating the Fed to pivot or to stop. They've made a mention that there could be a stop next time or maybe one more raise. Either way, people are getting excited. At least the mortgage market's getting excited about it. And usually that happens. Historically, you don't, unless the recession is caused by the housing market. The housing market actually is pretty resilient during other recessions. This recession being, I think, more of a government recession more than anything else. It has nothing to do with the housing market. Even though there's a lot of FUD here, we're still seeing it go. And when I talk to people all the time, I say to them, hey guys, you can look at several different, you can go to your loan officer, get rates, but the most important places I tell people to go to credit unions. Here's a local Southern California credit union. And guys, they're already here. Mortgage rates are in the fours, right? Credit unions are in the fours. They typically portfolio their own loans because of all the deposits from their depositors, right? And so they don't have to have these fees and paying this person off or that person off or whatever. They are quite less. And because of that, I really like this idea of having rates in the fours. People have laughed at me. Troy, there's no way rates are going to be in the fours by the end of the year. Guys, rates are going to be in the fours by the end of the year and possibly in the threes with these credit unions. I don't put that out. There's only a few black swan events that could happen that can cause rates going up. I know that there's doomsday, we're not raising the debt ceiling. Stuff that we've been hearing, but I don't know. The bond market really is at, in the fives right now for the 1 month, 3 month, 6 month, 1 year. They're all in the 5%. If they were to turn around and default, well, the government needs more money. And how do they do that? Go run over to Janet Yellen and say, create more bonds. To do that, they're going to have to pay a higher interest rate, which would be in the 6s and 7s. Interesting. That's where I think a lot of money will be flooding out of banks and going right over there. But I digress. Look at these rates. 15-year at 5.25. Are you kidding me? 5.6 ARM. You have a jumbo 5.6. You have a 7.6 monthly. 4.5. If you guys are banking on somewhere in the next, 6 to 8 months that the rates are going down, guys, these are great rates that are here. All right, so let's get right into the government. The FHFA, and I've been very critical of them. And in fact, a lot of people that are in the real estate industry have been really critical of them. Why have they been critical? Because it just seems like there's not a whole lot of experience there. And then they end up doing things that are completely disadvantaged for the average buyer. And they're always saying it has to do with socially impacted people. In my eyes, I don't see it whatsoever have socially impacted people. It's always about that being a narrative of stupidity. That's the real narrative. FHFA Director Sandra L. Thompson's statement on upfront fees based on certain borrower's debt to income ratio. Guys, we have mortgage insurance. If you're having typically a loan under 20%, you have the borrower pay mortgage insurance. It doesn't matter if FHA or conventional. That mortgage insurance ensures that the mortgage, if it defaults, that insurance company will pay. Well, some of those insurance fees and all these fees go to Fannie and Freddie, Fannie Mae and Freddie Mac. Those companies are flush with cash. In fact, so flush that Joey B up there in the White House is yanking the money out and spinning it towards, I don't know, whatever he wants to spin it towards. So it's not the lack of money that would typically happen. If we had a black swan event and we saw foreclosures hit, people start getting foreclosed, they're not going to really hit the market. This administration doesn't want to sell trickle down to real estate agents. They want their buddies, BlackRock, Blackstone, they want them to buy them all up and make the world a bunch of renters. We already know that. If you saw 2 days ago, I went over the three stooges of real estate. Let's go on another article from FHFA. FHFA rescinds GSE. That's GSEs are the Fannie and Freddie upfront fees based on DTI ratios. So one day, a year ago, she said, hey, this coming May, we're going to go and add debt to income ratio. We're going to charge you for debt to income ratios over 40%. And that's a penalty. You're in the penalty box. Then she said several days before that, hey, let's go ahead and push it off to August. Well, guess what all lenders have to do? They have to already prepare for it. So this is when they're buying. So Fannie and Freddie buys these mortgage-backed securities. They buy these mortgages. So if you bought a home in the last 90 days, you have been penalized already for this. And it's because, again, if you're, Rocket Mortgage or you're a mortgage broker or a mortgage company, you already, instead of having a fee of $1,000 or $2,000, which comes out of closing costs, they bump the rates up just because of this. So now when the FHFA says, just kidding, well, guess what happens? Those mortgage companies make more money because they anticipated having to pay more to sell those loans off, and now they don't. Who gets screwed? You got it. Socially impacted buyers, as well as all buyers, get screwed again by Joey B and the crew here. So we are now seeing that these upfront fees based on DTI ratios might be rescinded. Okay, but the damage has already begun. It's already begun for months and months now. It doesn't, again, what does the government do? They'll tell you, I won't raise taxes, but they'll do everything else to raise money off of you and steal it from you, regardless if you're purchasing a house or refining a house or anything to do, gas taxes or whatever extra, ordinary taxes, or raising utility prices and overtaxing those. They do all of this. That's the Democratic way, right? Well, let's jump into this. CNBC, this was Wednesday. I didn't go over this. Mortgage demand surges as Fed signals potential pause in rate hikes. Just kind of went over that at the first article here. But we're seeing that. We're just seeing that it keeps going up as rates going down. And I think that if we get rates in the fours, the move-up buyer, the buyers that have been sitting on the sidelines because they're scared of inflation, they're scared of bad decisions that the federal government's going to do, if they can get back to normal, we're going to see a normal housing market. But until then, no inventory. Guys, no inventory. Very few move-up buyers. The sellers out there are either flippers, right, or people that are deceased or moving into, it's an older generation moving, or it's people who want to get the hell out of California because our governor is a douchebag. Let's move on. Well, like I said at the beginning of this whole program, giving out 100% financing is probably the worst decision. So in real estate, it was the cause of the 2008-2009 recession, our country's recession. And so we have laws. We had the Dodd-Frank Act that came up that actually has been laughed off now by Elizabeth Warren. But now we're seeing other parts of the world go, hey, what's a great idea, guys? Let's give them 100% financing and let's not have them guarantee shit. Guys, what a bunch of shit here. Come on. Renters here, and we'll go over the renters in the UK will be able to borrow 100% of the value of the property without a guarantor in a new mortgage scheme introduced by Skipton Building Society. Guys, woke goes broke. Okay, if you can't learn from the past, you will learn from your punishment that you'll receive from today. This is going to be a complete cluster. Beep. Next, rates. Wow, rates are continually falling. This was a couple of days ago. I want to show you that we saw this dip in rates. The conventional went down about 5 basis points. We saw a little dip here in FHA, but conforming went down almost 21 basis points. This was for Wednesday. Now let's look at Thursday's rates. Bam! What do we see? Another huge drop. We're seeing 6 basis points off conventional, almost 10 basis points off of FHA. You know, if you're out there looking for a home, guys, we're seeing rates fall and we're all preemptive of the Fed stop raising. And if indeed Sandra Thompson over at the FHFA, if she then completely rescinds all these upfront fees for good borrowers, as well as the DTI ratio fees, we will see a little bit of a boom here in real estate, and possibly move up buyers will start to sell their homes or put their homes on the market in anticipation of them getting a better rate or rates that are more comparable to 2 or 3% that they have now, and their move up, and the market will smooth and will have a much we'll go back to normality. That is only if we see the Fed rate raises and the banks don't freak the hell out because everyone's pulling money out of the banks because they can get better returns in the bond market, right? And in money markets. If they can keep the money in the banks, then the banks will turn around and lend out. So there's a lot going on here that's happening. We also need the GSEs to keep buying these rates, these mortgage-backed securities or these mortgages. That in comparison, see this, guys? I'm gonna go flip this up real quick. What are we seeing? Downtrend. Here's the peak, right? And splat, right? We're going down. We need to head into the 6.2s, and I think we can go into the 6.2s unless someone from the Fed says that they're not stopping the rate hikes. We'll see the 6.2s next, hopefully by the end of the month. All right, guys, thank you very much for joining me today. Hope I gave you a good information. If you do, hit that like button, boom. I definitely would appreciate it. I'm trying to get this channel growing, and educate people on what's happening in the market. Yes, I am boots on the ground. Yes, I have a real estate license, and yes, I'm helping buyers out. I'm not on the catbird seat, sitting up there in a penthouse, looking at numbers, dissecting them, and seeing what best clickbait is out there for me to have for views. I'm not looking for that. I'm looking for solid info. You guys take care. Have a great weekend. I'll see you on Monday.